Oh, hi, I'm Max Keiser. This is the Keiser Report. Watson, come here. Remember those words from Alexander Graham Bell to his assistant? I believe his name was Watson. Launching the telephony age, and America dominated. Well, no more. Stacy.
I have two headlines here from Matt Stoller. And, you know, he does a lot of stuff about monopoly and cartels and all that sort of stuff, controlling our whole economy here. But I want to feel bad for some locals here in Manhattan. This is poor elite white-collar defense attorneys are being laid off because there's so little white-collar criminal prosecution. So the Department of Justice is not going after white-collar crooks, all the banksters and stuff like that. So apparently there's no need for all these white-collar defense lawyers, and this, you have to feel bad for them because it's usually a revolving door into working for those banks that normally get prosecuted. So, you know, they help defend them against the Department of Justice, and then they get a job at one of the big banks. But now that that rung in the ladder is not there anymore.
That's amazing. You know, considering the level of crimes out there, but they just don't go after them.
They don't go after
them. As ex-Attorney General Eric Holder said that the crimes on Wall Street, we don't prosecute because implied in that was he's on the take.
Well, actually, yeah, what Eric Holder was saying was it was essentially he wasn't able to sleep at the thought that he would go after these white-collar criminals, the banksters in particular, because it's like a game of kerplunk, our global financial system. You pull out one, you target one fraudulent, leg of the fraudulent debt, and the whole thing comes down. So therefore, this has resulted in a shortage of employment opportunities for
what a great
lawyers.
message Barack Obama and Eric Holder sent to the population. You know, if you're going to be a criminal, shoot high.
Exactly.
And shoot often.
Okay, Matt Stoller is also, like I said, he looks at the monopoly crisis across America and various industries and how it's destroyed innovation, how it's destroyed opportunity and the fabric of the U.S. economy. And here is a remarkable one. America's monopoly crisis hits the military. Wall Street's short-term incentives have decimated our defense industrial base and undermined our national security. So it looks at Huawei, and this is being considered a national security issue. They're the number one provider of 5G technology. They own all these patents. They have a better price on it. They're building all these high-tech capacity in China, and the U.S. is unable to compete. And in fact, many of our crucial parts in our military industrial complex come from China. But they say in historical terms, this is a shocking turnaround. Americans invented the telephone business and until recently dominated production and research. But in the last 20 years, every single American producer of key telecommunications equipment sector is gone. Today, only two European makers, Ericsson and Nokia, are left to compete with Huawei and another Chinese competitor, ZTE.
All right, right. And getting back to Alexander Graham Bell, and the telephone was created and it set in motion 100 years of American dominance in the telephone business, and the telephone business and AT&T and then Bell Labs were where all this innovation took place. The laser was invented, all these different things were happening. But America then, during the 80s, the Reagan-Thatcher neoliberal period, decided that they were going to go into the financial business, and that meant getting rid of all manufacturing jobs, gutting the industrial heartland, and turning everything into a financialized, commoditized security that can be packaged and repackaged and sold and resold on Wall Street. And now here we are in 2019, and Huawei, the Chinese telephone company, is the new Ma Bell. It's the new powerhouse of innovation. It's the new lead technology for the country that is now dominating the global technological infrastructure around the world. And that's a simple statement of fact without looking at any jingoistic or xenophobic angle. The fact is on the ground. Just look at the patents, look at the technology. China now leads.
Well, in fact, if you want to look at us warning about that about 10 years ago, go look at some of our interviews with Paul Craig Roberts, who was in the Treasury Department under Reagan. And he said exactly this, that innovation would collapse. If you're not manufacturing here, It's on the manufacturing floor, it's on the factory floor where innovation happens. And this will show that that's indeed what happened, but also financialization. And we're talking about Bell Labs. For over a century, America led the world in producing telecommunications equipment. The American telecom industry, according to Zach Model of Atlas Tool Works, a subcontractor in the industry, used to be a crown jewel of American manufacturing. Model's company had been a manufacturing supplier to AT&T and its Bell Labs from the early 1900s until the early 2000s. The radar system was invented here. The transistor came out of Bell Labs, the laser. I mean, all of these high-tech inventions that have both commercial and military applications were funded out of the research, Model told media. More than just the sexy inventions, there was a domestic industrial sector which could make the equipment. Now, in a strategic coup for our adversaries, that capability is gone. But it's not our adversaries that destroyed it, it's ourselves. It's Wall Street, he said, that they focused on short-term gains and forget about the long-term existence of this company. In 1996, AT&T spun off Bell Labs into a telecoms equipment company, Lucent Technologies, to take advantage of investors' appetite for an independent player selling high-tech telecom gear after Congress deregulated the telecommunications space. At the time, it was the biggest initial public offering in history and became the foundation of a relationship with financial markets that led to its eventual collapse.
Right. The problem with financialization is that it doesn't add to your tax base in that you're getting rid of all the workers that would generate taxes that create the real economy and the ability to manage a national debt. But when you financialize everything, you're giving money to the bankers who take their cash and they put it into, as I've said before, Swiss chalets or fine art or Hamptons estates, and that money is dead, therefore dead money. And because the real economy keeps losing its ability to pay off the national debt and the debt keeps skyrocketing, then the financialization genie, once it's out of the bottle, it keeps growing and growing and growing exponentially so that the leverage goes, and we had in 2008, you had a result of the leverage collapsing, and what did the Timothy Geithner and Hank Paulson and Barack Obama do? They wrote a check to Wall Street for, it started out on TARP as $700 billion, but it became $14 trillion. Now again, Obama could have bailed out every credit card holder and mortgage holder in America for the same price and restarted the economy for real, and we would be in a glorious American century. But instead, he bailed out the creditors, which is the first time in history that's ever happened, and now we're, in 2019, facing a repeat of 2008, but on a much, much, much bigger scale.
So with Lucent, you know, they focused on the stock price so much so that there was a live stock price board there in their offices in 1997. And all the employees were given founder grant share options. So they were all focused on the stock price. And that was the only thing they looked at, not innovation, not production capacity, not what they were coming up with. So the erosion of much of the American industrial and defense industrial base proceeded like Lucent. First, in the 1980s and 1990s, Wall Street financiers focused on short-term profits, market power, and executive payouts over core competencies like research and production, often rolling an industry up into a monopoly producer. Then in the 2000s, they offshored production to the lowest cost producer. Remember, it was 2001 that China rose to the World Trade Organization. This finance-centric approach opened the door to the Chinese government's ability to strategically pick off industrial capacity by subsidizing its producers, hand over cash to Wall Street, and China could get the American crown jewels.
Right, and think about the pie analogy. You know, during this time, people are saying, hey, you know, you're shifting the economy in such a way as you're bankrupting one part and you're enriching another part. The wealth and income gap is skyrocketing. And then the critics will say, no, 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 the pie is growing bigger for everyone. The rising tide lifts all boats. And what they fail to take into consideration is that all of this financialization doesn't steal so much from the present as it steals from the future. So the baby boomers are, thank you very much, I'm a baby boomer, riding the coattails of financialization for 30 years, thank you. But the millennials and Gen Z those folks are now heading smack dab into a depression because their future was destroyed.
Again, they point out that innovation doesn't just hover above the Great Plains. Right? It's built on steady incremental changes and knowledge learned out of basic manufacturing. So we don't have that anymore. All we have are Wall Street, private equity sort of vulture sort of finance, right? And he talks about the case of TransDigm. What these private equity firms are doing, they started out as a private equity firm. They bought up specific companies that sell one individual part crucial to, say, a fighter jet that the entire Air Force relies on, our entire military relies on this one little part. And TransDigm, which started as private equity in 1993, bought up one of these companies, and they basically started jacking up the price. That, okay, well, you need our part, and you have to buy from an American company for this. And they started like fivefold, sixfold, sevenfold increasing the price of the part that they were selling to the U.S. military, and the U.S. military had no say in whether or not they could buy it. So the TransDigm's gross profit margins, using this model of holding the military hostage to gouge the U.S. government, their profit margins are a robust 54.5%. To put this into perspective, Boeing and Lockheed's profit margins are listed at 13.6% and 10.91%, which presumably means that Boeing and Lockheed Martin will be bought by private equity so that they can then raise the prices to the U.S. military that Boeing and Lockheed Martin aren't doing.
Well, yeah, let's talk about Rob Reiner for a second. I just read a tweet. You remember Rob Reiner, meathead from the All in the Family show?
Yeah.
He was tweeting that, this foreign government is attacking America. We need to be... Okay, here's TransDigm is an American company that is bankrupting the U.S. military to the point where the U.S. military can no longer defend Americans here in America. So that's an obvious existential threat from within. The company is called TransDigm. Rob, meathead.
Yeah, there's a whole list of them in this article. You should read it. But they do say it's the same system we have in healthcare and education. It's just terrorizing the population, essentially, defrauding them. It's a shakedown. It's a nickel and dime, TransDigm. It's nickel and diming the American population to death and getting nothing. We get no results for our healthcare system or our overpriced healthcare system. We get no results for our military, like the hugest... As I point out, 8 times we spend as much as the 8 biggest militaries after us. So it's all going to basically fraud.
Right, and meanwhile, the countries that you should look at Russia not for this this kind of phantom existential threat, but look at what they're doing financially. They're buying gold, as is China. Understand what's happening. Don't let your biases and your phobias and your Russophobia turn you into a meathead. All right, we're going to take a break. When we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Marshall Auerback. He's a research associate at the Levy Institute. He's a follower of the Toronto Maple Leafs up there in Toronto. He's also, he's a big thinker, an academic sort. I follow him on Twitter, as do many around the world, for his insight. And we're going to talk some big picture stuff today, Marshall.
Big picture, okay. Good to be with you.
And we caught you on the off season because
that's right.
During the season, it's too stressful when the Maple Leaf.
It's true, and the lines on my face would be considerably more, and I'd have a lot more gray hair. So yeah, you caught me at a good time.
I know that we would love to actually just be talking about hockey, but we must talk about this other stuff. Okay, so we recently interviewed Dr. Michael Hudson for our Double Down podcast, and he says, in all of his studies going back to the Bronze Age, he's never heard of negative interest rates. There are now 14 trillion in negative yielding sovereign bonds. What do you make of this?
Yeah, it's crazy. And in fact, you've got to the point where I think we've really have reached the limits of how much the monetary gymnastics can be undertaken by the central banks, because, I mean, you are literally paying countries in Europe to have them, the people that save in those nations' bonds are paying the governments to hold them, and these countries, being part of the eurozone, for the most part, they can be technically bust at some point because they don't issue their own currency. So it's the height of insanity, along with the 100-year bonds. Ireland issued them. Remember, Ireland almost went bust a few years ago. The Austrians have done the same. They're about to issue a second tranche. I mean, I can't even predict more than 3 to 6 months out, but somehow these guys that buy 100-year bonds figure that they can manage to forecast what's going to happen over the next 100 years. It's incredible.
What's the difference between a negative yielding sovereign bond and a default?
So yeah, one man's default is another man's negative yield. The point is, there's been studies that have been done which would indicate that when you get to that kind of rate structure, it actually starts to be antithetical or inimical to economic growth. So we're already past the point where you keep cutting and somehow it's going to do any better. And of course, you can't actually offer less than zero interest rates in banks, or you'd probably trigger deposit runs, which we ostensibly sorted out several decades ago. So this is one of these great ideas. So it's a terrible environment even for the banks as well as it is for savers.
Well, Dr. Hudson actually thinks that we could see these negative interest rate bonds on the sovereigns getting down to negative 25%.
Yeah, I think the whole thing blows up before we get to that stage, but I can see what the thought process is behind that.
You're saying it's counter to growth, that when you have this type of accounting fraud, some might call it.
Some might, yeah. We of course wouldn't, but others might, yeah.
Some might use those terms. But in conjunction with some other things the central banks are doing, like they're buying back stocks, right? Bank of Japan buying stocks, the Bank of Switzerland buying stocks.
Yeah.
Now it's rumored that the European Central Bank will buy stocks in the open market. Maybe the Fed will do so. How does that factor in?
There's been chatter that the Fed has been doing this for literally decades. I mean, we all hear the stories about the so-called plunge protection team. And then, of course, you had that famous speech by Robert Heller, who was, I think, head of the San Francisco Fed, and he publicly mooted the idea of the central bank buying stocks back in the late in 1989. He said this at the Commonwealth Club in San Francisco, and this, of course, was after the '87 crash, which seems like kids play compared to what we've had since that time. So there have been periods where all of a sudden you get this mysterious bid in the market just when it looks like it's breaking down. And it seems that, as you say, the Japanese have already explicitly done that. And now it looks like the Europeans are doing that. So you're further perverting the function of a capital market, which is to cycle or to provide capital to worthy companies, help them grow, help them invest, and thereby create jobs. Here it's being used as a reverse wealth recycling machine. So the central banks buy these stocks, support the CEO options for a lot of these companies, enrich the rich even further, and then when it finally crashes, of course, these guys have already cashed out. They'll buy from the assets back from the distressed sellers, and on it will go. There's been some excellent work done by Branko Milanovic, who's I think at CUNY right now, but when he was at the World Bank, he pointed out that when you have financialization combined with this kind of stock market activity and financial bubbles, that ultimately in the aftermath the inequality tends to expand even further, and that's what's happening. It's going to get worse if this trend that you've pointed out continues to go on.
So you're calling it a reverse wealth machine. It's gouging into wealth. It's causing this wealth and income gap. It's causing what some call a serf economy, where you have lords and serfs, kind of pre-enlightenment, the modern economics. Going.
Yeah. Well, you go. I always use the analogy of H.G. Wells's The Time Machine. And you also have the made-for-TV movie that was made, where you have the Eloi who live up in the celestial heavens, and they've got this class of people, the Morlocks, who literally live below in the caves, and they serve to sustain their economic life, and that's sort of what we're heading.
Let me throw in a term I came up with. See what you think about it. Being a thinker and all, I call it interest rate apartheid. So in other words, if you're on the right side of this, the class, the right class, your cost of borrowing money is zero or less than zero. If you are in another class, you're paying usurious rates over the credit card companies, mortgage companies, and everything. So they're creating Bantustans of impoverished folks, using the mechanism of interest rates, not by putting them behind bars, but by just saying your cost of your credit is now 30% a year, and over here it's less than zero.
Yeah, it's the 21st century equivalent of the debtors' trip prisons that Dickens used to write about. But as you say, instead of putting you in jail, they just wipe you out by making you pay these extortionate interest rates. And of course, the credit card companies have been huge beneficiaries of this. In fact, Joe Biden, one of the leading candidates for the Democrats, has a long record of backing the credit card companies in this regard. So did Hillary Clinton. Elizabeth Warren, to her credit, has started to challenge this orthodoxy. But it's been a big problem. And your analogy, interest rate apartheid, I like that.
No, you can borrow
good.
that.
Yeah.
I'll see that. The Levy Institute will soon be writing a report about that. I just asked for accreditation. Okay. So speaking of these Democrats running for president, let's talk about Andrew Yang.
Yeah.
Okay. He's candidate for Democratic nomination. He's proposing a form of universal basic income. This $1,000 a month he's talking about.
Yeah.
Your thoughts on this, and if central banks are going to be in the business of owning stock, shouldn't the taxpayers get a cut of that? But let's start with universal basic income and Andrew Yang, $1,000 a month. What's your take on that?
I think it's a terrible idea. I just think when you start officially breaking down this nexus between work and productivity, that it just further undermines the system from within, and so I don't like it at all. And to me, it's like and it's interesting that the Silicon Valley oligarchs are the guys that keep proposing this, because it means they can just keep getting rich. They don't address the underlying system which creates this massive wealth income gap, but it acts as a huge painkiller. It's like the equivalent of Oxycontin, you give to those poor people that can't get a proper job, and you can just go on and robotize the entire economy with guilt-free because you're giving them all a UBI.
Well, let me give you the other side of the argument here.
Yeah.
Part of the problem is that Americans in growing numbers feel disenfranchised. They're not really part of of this economy anymore. They're being marginalized and imprisoned. So here you're getting, instead of calling it a universal basic income, let's call it a enterprise dividend. And that you pay my taxes every year, and I'm essentially participating in the American enterprise. And I get my dividend every month, which is by participating in this enterprise.
But how are you participating? If you're sitting...
Well, the thing is, once that is adjustable. So in other words, the greater the economy comes to life, and the greater we as a country can come together to pay down our debts and increase our productivity and be more competitive, that number will go up. So here's $1,000, and let's get it to $10,000. We got to do this, we got to do that, but let's join this enterprise and here's your dividend.
Why not do something like a job guarantee where I think most people would rather work and actually be involved in the productive elements of the
But
US economy.
It doesn't preclude working. I think it would, but it does give meaning to the act of paying tax, because right now the perception is you just throw your tax into a pit and it goes nowhere and the debt keeps going higher.
Well, I would argue that a UBI would actually further accentuate that perception, because you'd have a lot of people saying, yeah, I'm just paying taxes, and we just give anybody here $1,000 a month actually. So at least if you've got a job guarantee, I think at work, and I'm not advocating a form of workfare. I think you have to do it at a sensible wage level with a sensible range of benefits as well. But at least there's a much more explicit quid pro quo between your participation as an active member of society and the compensation you derive from it.
Right. So work guarantee, job guarantee, that kind of spills over into the government getting into, quote, picking winners?
No, not necessarily. The government simply funds, because it has the unlimited capacity to do so as the currency issuer, at least in this country and also in the UK or Japan or Canada. But it doesn't have to be the person who allocates, the entity that allocates or tells you what you have to do. That can go down to at the local level, municipal level, the state level. It can be done in the NGO space. So all you need is it can be publicly funded but privately administered. So it's not a question of government picking winners and losers in that situation. We're not talking about a massive, huge state centralized bureaucracy a la the Soviet Union.
Right. Well, it has occurred in the past during the Roosevelt era. They had huge public work programs.
And then they were very, very successful.
Right. You had Eisenhower build the interstate highway system.
Yeah, and it goes back as far as Hamilton, and then of course John Quincy Adams did the same thing with the canal system. So
there's jobs to be done.
Well, just you're visiting in New York. Walk or go through the subway system. You could spend a few $1 trillion just upgrading that alone, actually. So, and those would be high quality jobs, actually.
All right, so let's move on to another candidate. Of all the Democratic candidates, Elizabeth Warren has one of the most Teddy Roosevelt-like trust-busting vibe going.
Yeah.
She's going after the monopolies and oligopolies that dominated America and private equity, which is hollowing out retailers. Do we need a Teddy Roosevelt before we can ever think of having an FDR?
It's a good question because the general perception is that both TR and FDR, they were trust busters. They were trying to break up these big corporate concentrations. But in fact, ultimately, both came to the view that it wasn't size per se that was a problem, but they did feel that you had to. They regulated more with an outcome in mind. So I like a lot of what Warren says.
What do you mean they regulated with an outcome?
Well,
in mind?
in other words, that the regulation becomes size neutral. It's interesting that the vast majority of companies that offer high-paying jobs with good benefits are larger national companies. They're not small little mom and pop shops. Those are usually the ones that find it very hard to, when the additional costs are imposed on them. They're also the ones that tend to be busting unions, et cetera, et cetera.
All right, hold that thought. We're going to cease this and pick it up on another segment. Thanks for being on this episode.
Thanks for having me.
All right, that's going to do it for this edition of the Keiser Report with me, Max Keiser and Stacy Herbert. I'd like to thank our guest, Marshall Auerback. If you want to reach us on Twitter, it's Keiser Report. Until next time, bye, y'all.